Hello, my name is Lindsay Shuck. Thank you so much for joining today's Family Office Network's webinar series, How Family Offices Can Partner with Venture Firms and Corporates for Enhanced Returns. At the end of today's presentation, we will have time for Q&A. Please use your questions chat option on your screen to send over any questions you may have. Moderating for us today is Eric Ball, General Partner with Impact Venture Capital. Eric, I'm going to let you start us off to introduce our panelists for today.
Wonderful. Thanks so much to Lindsay and to the entire Family Office Network. Some of you have heard me before. I co-hosted a webinar on June 18th. My own brief history is that after 28 years working in finance for Oracle and other large corporates, I co-founded Impact Venture Capital in late 2016. Some of you attended that earlier webinar in June, which made the case for allocating capital to venture in the year of COVID and described how we at Impact Venture Capital approach making applied AI investments into early stage startups. Today, I have invited a couple of friends to help us provide information that may be useful to those family offices allocating capital to venture this year. One of our panelists may be having some technical difficulties, so we're waiting to see if we will have one or two panelists join me today. But I'd like to introduce our first panelist, Michael Beaudoin. Mike directs and manages Mark IV Capital investment in private equities, including seed rounds, Series A rounds, Series B rounds, and several funds. Mark IV is a large family office, the largest in Orange County. Prior to joining Mark IV, Mike participated in AT&T's leadership development program, where he held various management positions and started the Aspire Accelerator. Prior to AT&T, Michael held vice president roles at JP Morgan Chase, Deutsche Bank, Bank One, and he started his career with Merrill Lynch. Michael graduated with an MBA from Pepperdine's Gradazio School of Business, and he holds a BS from Ball State University. Very, very happy to have Mike joining. Could I just ask if Victoria has found us? Okay. Well, if she's able to come on, we'll go ahead and introduce her as we go. In the meantime, we'll go ahead and get started.
It looks like Victoria is going to be joining in a minute here. She's getting logged on now. If you want to introduce her, and hopefully we can get her all set up.
Oh, that's great. Victoria Cheng has served for the past 6 years as vice president at Citi Ventures. In that role, she has invested in and partnered with startups developing new technologies and business models. Victoria covers commerce, data, financial technology, and enterprise IT. She says that she's fascinated by companies leveraging mobile to create the next generation of financial services experiences, and she has also worked on Citi's Accelerator program. So we're very pleased to have both Mike and Victoria join us. What I'd like to do today is divide the discussion into 3 sections. First, ask each of the 3 of us to take 3 to 5 minutes to describe our respective organizations. Then I will ask some questions of each of our 2 distinguished panelists about how they invest and how they see investment syndicates working together, often including a mix of family offices and corporate venture arms and independent venture firms in support of promising early stage tech startups. Then I want to leave time for a 3rd section where we'll take questions from all of you in the audience for our panelists. To start things off, I'd like to take 3 to 5 minutes to offer a refresher to some of the data we brought to you in June. Over the past 30 years, there's been no asset class that has had higher returns than early stage venture. Over shorter periods, returns to different asset classes can be pretty tightly clustered. But once you move to longer periods, venture tends to outperform, and early stage venture really distinguishes itself as a separate asset class from late stage venture in offering the highest performance. The risk return advantage of early stage venture tends to be even more pronounced in a crisis. This is because conventional investments suffer. This year, in the wake of COVID, we've seen domestic stocks and international stocks experiencing unprecedented volatility with the VIX at highs. Real estate has been volatile, and fixed income offers very low yields, or what I like to call reward-free risk. In a crisis, venture valuations are often lowered, and by the time those companies mature and exit in 3 to 5 years, the crisis has passed, and those lower valuations today can translate into higher multiples at exit. We've looked at a lot of data, including the data from 2008, a year that gave birth to several prominent startups in the middle of the financial crisis. As a vintage year, 2008 was the second best year of the decade, and we see similar opportunity in this year's crisis. This is borne out from a more detailed analysis of 4 past crises, which we've graphed here, which show that the best time to allocate to venture capital, especially to early stage venture, as an asset class distinct from late stage venture, is 1 to 4 quarters after the low point of any crisis. The conclusion that we reached in June, and still reach today, is that whatever your long-term average allocation to venture as an asset class, analyses of past crises indicates you may want to increase that allocation at the end of 2020 and the beginning of 2021. At Impact Venture Capital, a core part of our identity is our strong collaboration with corporate venture arms. I used to manage Oracle's corporate venture portfolio, and I engaged Jack Crawford as a consultant to assist me in 2012. Jack is now my partner. When we formed Impact in 2016, fewer than 1 in 10 venture deals had included a corporate investor. In 2019, more than 4 in 10 venture deals had a corporate investor, and they have been the primary driver in the growth of venture dollars in the ecosystem. Often, corporates and independent VCs have differing objectives. Here at Impact, we've sat on both sides of that table and are convinced that we see a stronger quality and quantity of deal flow through our partnership with corporates. We have co-invested with several, including SK Hynix, Yamaha, Baidu Ventures, Goldman, Bank of America, Datalogic, and several others. For my last slide, I want to summarize by saying that we see this as an opportune time to deploy capital into startups, and we see partnerships with family offices and corporates as a higher expected return way for us to go about that investment. We launched our own fund too at the end of last year, and we'll hold a second closing this quarter. We're looking for 5 to 7 major partners among family offices and institutions to round out our LP base, and we'd welcome the chance to tell you more about it. You can also find more details about our fund on the new marketplace platform launched last month by Family Office Networks. I encourage everyone to check it out, both our own overview on that platform, as well as a chance to check out other funds, both in venture and in other asset classes. With that, I want to end my remarks and turn it over to Mike to provide a little bit of orientation to Mark IV Capital and his role there. So Mike, I want to turn it over to you for the next 3 to 5 minutes.
Well, thanks, Eric, and thanks again for having me here. One, I'll point out it's always great to come support a venture firm that is our #1 performing venture firm right now. So congratulations again for your performance this quarter, and an outstanding stellar performance during COVID in general. I mean, I think you guys are up to 2 exits in M&A transactions, which was once again kind of part of our original thesis for the investment, but just kind of shows the deep network of corporates that you work with and the broad spectrum of them. And so my role at Mark IV is I get to wear 2 hats. I am the portfolio manager, so we decide the top-down strategy of where we think the world is going over the next 3, 5, and 10 years. And then we actively look for both asset managers and direct transactions to implement that strategy. And so our allocation right now is about 20% into funds, about 80% direct. And on our funds, we really use an ecosystem approach. So, one, we'll look for funds that are either, I use the phrase up, down, top, left, or left, right quite a bit. And we'll look for funds that are, part of our ecosystem, whether they're in our geographic areas, they're aligned in either an earlier state than what we would normally invest in, so we can kind of sort, harvest, and find and position ourselves to be in the later stages. Or on the flip side, we'll also work with some venture firms that have some expertise in the later stages of a company, whether that's access to capital or access to corporate partners to help the companies, continue their growth trajectory. Overall, and then the third part is always diversification, right? There's always things like biotech that is a very costly endeavor, and it's hard for us to manage multiple focuses inside the firm. So we generally 100% outsource our biotech transactions. But yeah, overall, Mark Ford, we were here as a diversification for a family that had a event with a public offering, and that was originally started to diversify a concentrated stock position. And so initially it started in real estate and then moved through very different facets of real estate, from industrial to Class A office space. They actually now will acquire dirt, design, and build all the way up, and then manage the property in perpetuity. And as we went down that path, they decided to go ahead and add venture capital and private equity, because as you're mentioning, not only has it been the #1 performing asset class, it is completely uncorrelated to public markets and to real estate environment. So as a testament to your guys' performance in this period of time, we're still seeing M&A, we're still seeing exits, we're still seeing liquidity events, and we're still seeing upside performance, even in a capital constrained, more difficult economic environment.
That's great. And I'm that sparks several questions that I'd like to understand better. But first, I'd like to turn the floor over Victoria, and welcome, Victoria. I have you listed here in your Citi Ventures role, and I don't know if you have any updates to that. But I wondered if you could introduce yourself and also describe a little bit about your current role and how you're allocating your own time.
Yeah, so I think this is a little bit dated. So I am a partner at Proven Capital. It's a venture capital fund built in partnership with Prudential Financial. So I was at Citi Ventures, and I'm happy to talk a little bit about my time there as well. So we are a $300 million fund. We're focused on accelerating the growth of our investments by leveraging our larger partners platform. My partners and I, we're experienced investors, all from Citi Ventures. Spent nearly a decade there building out that platform, and we took a lot of the learnings that we have there, created this independent fund, which we believe is the best of both worlds, right? So we have the backing of a large corporate, makes us stronger as a VC fund in order to win deals, diligence deals, and then post-investment, which I think is really critical these days, grow the portfolio companies, and hopefully we'll end up getting to superior financial results, right? That's the whole thesis of our fund. So my background, I've been a VC investor for a long time now. First at Core Innovation Capital, then at Citi Ventures, investing in fintech companies like Plaid, Ripple, TO Opportune, and then e-commerce companies like Jet and Hopper, and then enterprise IT companies, DataRobot, Braze, Muta, et cetera. So been in the venture world for a while at this point. And then at Citi, I also launched our Citi Impact Fund. So that's a $200 million fund focused on investing in companies that were solving some key societal challenges, right? So the view that I had was, let's leverage the platform that we've built, the capabilities that we've built, and let's use that to actually benefit and make the world hopefully a better place through technology. So, that was really what we were looking to do. And the areas that we focused on were around sustainability, infrastructure, workforce development, and financial capability. And a key part of the infrastructure thesis was an area that's a passion of mine that we continue to invest in here at Proven, which is around health tech. And I think the virus and the pandemic has really highlighted a lot of the gaps when it comes to technology in our healthcare system. And perhaps even the business models that exist within our healthcare system. And then in addition to all of that, we also had a seed program inside of that Citi Impact Fund. And the purpose was about creating these equal opportunities in venture and startups, right? So how do we help women and minority entrepreneurs have that ability to really access capital that might have been previously very elusive, right? And really create that pipeline that our industry continues to talk about.
That's great. And just to clarify, so now that you're at Proven and publicly at Proven, it's an independent venture firm. Did you say that it had an early link to Prudential, or did I mishear that?
Yeah, so we built it in partnership with Prudential. I think we'll have a much bigger press announcement that we're coming out with that can provide a lot more detail into how that structure works. But the idea was, how do we create this venture fund that has the best of both worlds, right? So we have the freedom to really invest into companies as we see them coming down the pipe and really transforming the future of insurance, the future of financial services, the future of healthcare, while at the same time bringing that value add to portfolio companies, right? Helping them be able to accelerate their growth by leveraging a much bigger platform than ourselves as individual investors or managers. That's really the thesis that we put together.
That's great. Well, congratulations on the move. I know that it's relatively recent, and I had listed you at Citi because I wasn't sure if you'd come out of the closet yet on the move. So I'm happy to hear that that you've made that transition, and it sounds very exciting.
Yeah, we're excited about it.
Yeah, no, that's great. So what I'd like to do is just alternate questions for each of you, and spend the next 15 minutes or so with a couple of my own questions for each of you, and then invite our audience to submit questions so that I can turn the Q&A over to them, and let them hear what they want to from each of you. Mike, let me start with you, and I think you touched on this, but I'm curious, how are you leveraging the venture managers that you have backed to source deals, perform diligence, co-invest, participate in rounds, collaborate? How do the venture firms that you invest in help become a resource for you?
Yeah, great question. So, we start off with, we are limited partners, but we take the word partner pretty seriously. So, number one, we're in a fortunate position to have access to, a number of different venture firms. So we have a pretty rigorous due diligence process. And it all starts with that master allocation strategy and finding the right partners for each sector that we're looking to allocate funds for. But then as we start the due diligence process, we're also very forthright that we do have a direct program. We do have access to quite a bit of deal flow. And we are looking to create a portfolio effect between our venture managers as well as our direct allocations. And so, we really look for managers that are going to have added value, whether that's access to HR and recruiting, which a lot of venture firms are starting to be able to specialize and find good people that perform really well in other parts of their portfolio, and then bring them over to new companies where maybe they're just not the right fit for the company once it hits 150 employees or 1,000 employees, and they're more excited to come to work every day when it's a smaller team building something new. So kind of that virtuous cycle on HR and recruiting talent. Corporate investors. So what are the networks where they can help add value? So for instance, I think some of the companies that you guys have worked with and helped bring into our portfolio companies, have added value in sales, understanding marketing, understanding a customer base that's broader, deeper, really able to help focus that brand messaging. And for instance, when I was at AT&T, it was being able to just bring some of those corporate assets of professionals that could help the companies just expand and understand their target customer a little better. So we really look for venture managers that are and on the flip side, as I mentioned, we also have that ecosystem view. So if a manager is possibly in that early stage space where we're going to be looking to them to possibly find those Series A, Series B transactions and have more data and be able to make a faster, more qualified decision because we've been really following the company for 6 to 8 months. But we're also very forthright with those managers because not every venture firm wants a partner like that. And that's okay too. Possibly they have a growth fund, possibly they have LPs that are seeding them as well. And, maybe they're large PE funds or banks or other issues that, make that ecosystem important to them as well. So, we really have to view it as a partnership. It's a long-term partnership. They're 10 years. Unfortunately, sometimes up to 15 at this point. So we need to make sure that people we can work with on a daily basis and add value total to our portfolio.
Great, that's great, and I think that some of the other family offices may benefit from your own experience, because I think you guys do this at a larger scale than some family offices do it. Victoria, let me turn back to you. You touched on health tech, but I wondered, how has your focus evolved in the move from Citi Ventures to Proven Capital Partners in terms of industry sectors, stage, investment size? Is that going to be different, or is that really changed for you?
Yeah, so there are some overlapping areas because at the end of the day, I think for venture investors, you want to make sure that you have an expertise that differentiates you in the market, right? And also an expertise that hopefully you can add to your portfolio companies. So in terms of investment verticals, we will continue to be investing in fintech, insurtech, as well as the horizontal technical infrastructure, right? All of enterprise IT, automation, AI, security, customer experience, developer tools, etc. But in addition to that, I mean, health tech is going to be added to that portfolio because I am very bullish over the next 10 years about the impact of technology in the healthcare vertical, right? Similarly, we're also going to be investing in prop tech. I think they have very, very alike characteristics, right? Where you have these industries that are very large in terms of market size, but they are also a bit more behind when it comes to technology infrastructure, digital experiences, really leveraging everything that I think we have to offer in other types of industries, right? So the same wave that I saw in terms of fintech, followed by the same wave that followed it in insurtech, I think we will see that in health tech as well as in prop tech, right? So big wins in the next 10, call it whatever, 10, 15 years in that space. In terms of stage, we're multi-stage, right? So, I think different funds have different perspectives on how they approach this, but we have the flexibility to invest into a Series A company. We can invest into a Series D company as well. The way that I think about it is that, look, like there is a power law to venture, right? So there are going to be certain companies that will just outperform others in a massive way, right? Orders of magnitude. And so we want to make sure that we have the capability to invest into those companies. I would say that the way that we think about stage is also less of the letter and more of the stage of the company and its development. So post-product development companies in market, the ones that have proven the ability to execute on building a product, I think those are the types of teams we want to back. And it's very likely, and I would say most of them will not have actually scaled that business, right? That's where we come in. That's where we can also add some value to those companies. But that's also the type of risk that I'm really excited to take, right? So investment size really varies with that stage, right? So, it might be 5 million, it might be 20 million. It just kind of depends on what the company is actually looking to raise in order to achieve their next milestones.
And that's interesting. And I'd like to follow up now first with you, Victoria. How has your LP base changed? I mean, with Citi Ventures really being an offshoot of Citi, I think you're now operating with a more sort of conventional GP LP structure, and I'm curious how that looks. And also, at Citi and at Proven, have you worked with family offices, and has that informed how you invest?
Yeah. So at Citi, very different structure. We were off the balance sheet, so it was the company's capital. Here we've transitioned, to your earlier point, into a GP LP structure, and we did that very purposefully and very thoughtfully. Felt that it was the best way to align what we were trying to achieve in terms of goals, as well as incentives for the team and for the LP that obviously is interested in innovation, right? So ensuring that we could move as quickly as the venture industry needs us to move for the deals that we want to be in. I would say that, at Proven, for Fund 2, absolutely, we're very excited, and I look forward to bringing on more family offices into our LP base. We don't have any right now today in Fund 1. I love family offices. I think they bring a different set of capabilities to a lot of the investments that I've been involved in. They are flexible. They can do smaller checks. They bring a different type of expertise depending on the background of the family itself. So I'll give you a couple examples, right? In fintech, you need different types of capital. It's not just about having venture capital, right? So we've had a lot of family offices who have been the first warehouse debt provider to a company at a size that the company actually needs, right? We've had them come in and provide subordinated debt into an SPV for some of our lending firms, right? So I think that flexibility in the mandate of the family office and the ability to actually offer, what I would say is different types of financing structures is super, super interesting in the world of financial services and in the world of insurance, right? So I think the one thing that we always focus on is ensuring that the family office that wants to come in, does bring a level of sophistication, right? They understand the venture world. They can move as quickly as, a deal might close, and they're clear on what those investing returns might look like, and they want to be invested into the companies for what is a very, very long timeline, right? So I think when all the parties are on the same page, I think family offices are incredibly valuable to the venture community.
No, that's great, and that's, I think, most of these early stage startups have a mix of investors. They have the corporates, they have the family offices, they have the independent VC firms, and so pulling together a syndicate of sort of very disparate backgrounds, I think, is a key element of what we all do. And I'd like to follow up on that thread back with you, Mike, and ask, what percentage of your investments at Mark IV involve co-investment with corporates? And how are you participating in syndicates with corporate venture arms? And have you seen any difference in returns for those those companies that involve a corporate and those that don't?
No, thanks. And I think part of it was my background at AT&T prior to coming over to the firm. So my natural network tended to be corporate investors. But I think they do take a lot of risk out of a transaction. Right off the bat, as I mentioned earlier, understanding that customer, having established distribution channels, having access to capital. So corporates can, add a lot of value. I think they also have to be not seen as the panacea that's going to solve all the company's woes either. And a lot of times they can be, an early investment on a path to an acquisition if it's something where, they're very aligned, in their strategic stack somewhere. But I'd say overall, access to early sales and, early credibility to help, because a lot of our companies are B2B, so companies are often adverse to change if they don't think the company or the startup could possibly be there in 2 to 5 years. The cost of switching is too high. And a lot of times by adding that corporate investor or having that corporate investor make that initial introduction, that bias tends to go away quite a bit. And so, yeah, it helps them early on the sales side. Like I said, access to capital is phenomenal. Bring in possibly other professional tools. So whether those are like PR agencies or access to talent, because a lot of times in leadership programs, they like leaders to go through some stage where they're helping build a new business from scratch. So they bring a lot of industry knowledge and expertise. So yeah, we've had a phenomenal experience with corporates in general. I'd say well over half of our companies, and this is probably more meticulous and by design, have some type of corporate venture group involved. And, to kind of mention one of Victoria's comments there as well, one of the reasons I enjoyed moving from, the corporate venture side over to a family office is that dissolving of a prospectus. And so we do have a lot of flexibility. So for instance, when a venture firm called us and said, Mike, software is eating the world, we all understand that by mandate and prospectus, I have to invest in software. However, it's all got to run on something. And there's this hardware over here, but I don't know any other venture firms that are able to invest in it. As a family office, we were able to take an early stage, early bet into the company. We knew it was a proven group of leaders that also had grown a publicly traded company from 80 million to 800 million in sales. So they've had deep expertise in networks. But we also knew they were having a hard time looking for capital because so many prospectuses were requiring only these verticals to invest in, which as an LP, I also appreciate, right? We do want venture managers to do the job and fit in the box or plugging them into our allocation. So you're right. I think having this mix of family offices and traditional venture firms and corporates, the three, when they can work together, produce extraordinarily outsized results.
That's great. And Victoria, you've also touched on this, but I wanted to ask, you know, you were an investor prior to Citi. You invested in Ripple and some other very exciting firms. Then you went to the corporate venture part of this world, and now you're back to a conventional GP LP structure. How will your experience at Citi's corporate venture arm inform you know, how you operate at Proven, both in terms of your internal processes and how you choose or don't choose to coordinate with corporates in your new investments?
Yeah, so yeah, it's interesting. I kind of I wouldn't say I did a circle. I actually did an amalgamation of my two prior experiences. So I was at an independent fund. It was also a first time fund. And it was great, like, you know, wonderful experience building that up. And then joined Citi in order to have exactly what I was talking about, right? I think the venture world is extraordinarily competitive these days. And so there's a big question around what is the value add that you can bring to these portfolio companies that makes them excited to have you be, you know, part of their board, a part of their company over the next 10, you know, 12 years, right, potentially. And as a founder, the capability to fire them, right? So I think that, you know, all of those considerations means that, you know, they're really looking for platforms from VCs that can accelerate their growth in really exponential ways. And so what I ended up doing when I moved to Citi was to find that global platform, right? We had so many capabilities. We have a presence in almost, you know, all the countries that you can like think of, right? Like we have all of these resources. We have, you know, expertise in financial services, in our infrastructure, and, you know, regulatory affairs. Like there's just so much value that we can bring to our companies. But at the same time, you know, we were part of a much larger corporate entity, and so that in and of itself obviously also has its considerations. So what I wanted to do was to be able to really put those two things together, and that's what we've got here at Prudential, where we have the independence to make the decisions that we want around what companies do we invest in, how do we invest in them, what kind of structures do we invest in, you know, all of that kind of stuff, right? But we also have the ability to draw upon this very, you know, significant platform that helps make us smarter about the investments that we're making, gives us better access to investments, hopefully, and then also will allow us to leverage a platform that can grow our companies in really interesting ways through partnership. And one of the big things for us there was, you know, it's not enough to just have an LP write a check into us as a VC fund, right? We really want to have engagement. And so we actually have dedicated individuals from Prudential who work closely with us, right? So we can actually, you know, not just make an introduction, but hopefully also move things forward when it comes to, you know, bringing value, bringing partnership opportunities, bringing business development opportunities to our portfolio companies. So I think a lot of the things that we have built here today and the infrastructure and the way we think about, you know, sort of the API access, right, between us as the GP and our LP was built from all of the experiences that the three partners have had in our prior funds, right? All of us came from traditional VC funds and then into a larger corporate fund, and this is really the amalgamation of what we feel like is the best practices from everything that we've seen, and the platform that we would want to build if we could do it from scratch.
No, that's really helpful, and I think that you have a unique lens, having, you know, I talk about having sat on the corporate side and the independent side, but you've sat on multiple sides of the table, and I think that gives you a well-rounded lens. I'm going to ask the same question of each of you, starting with Mike. But before I do that, I want to encourage our audience to submit questions. We do have some questions coming through, and I'm soon going to turn to those questions. But you know, please continue to submit questions, because we really want to address what you want to hear about from the set of experiences of the people on this panel. And while we're assembling more questions from the attendees, Let me ask first, Mike, what advice would you give to smaller family offices who might not have had as much direct interaction with either large family offices or corporates on how to leverage these syndicates in early stage tech investing?
And so we get this question a decent amount as new wealth creation events have happened for people we know, and yes, what have you done? This firm's been around for 3 generations now, and one of the first things we always recommend is you sit down and think about this like a business with a real business plan. What is that allocation? What is your end goal with it? And really think about the resources that it's going to take to do this. I think there's often a perception that VCs in particular are very, very lightly, run. They are very easy to get deal flow because if you tell people you have new money or you end up in the newspaper, you get all these inbound calls. And really, you've got to flip the script back and become more of a hunter rather than a gatherer. And being able to understanding, here's my strategy, here's where I want to go, these are the resources to find it, whether it's people, whether it's time, whether it's effort, and make sure that you are really looking at that lens to understand that there's going to be a significant amount of time involved. And as VC managers, we get calls all hours of the day. We get the, it's 5 o'clock on a Saturday, we might run out of money by Monday. What are we going to do? Or there's a merger and acquisition. We need to start signing off and we need to be nimble. But it does take time, it does take effort, it does take energy, and it does take resources. The other one we always suggest too for a lot of the smaller family offices, don't underestimate those resources. There's a very talented group of individuals that are highly sought after, whether it's from corporates, whether it's from VCs, whether it's from mutual funds, but there is a skill set here that has a high demand behind it, and often it's much cheaper to work with other LPs and to be able to fund that skill set. So access to highly talented managers, because manager selection is the #1 determinant in your end-all return. So when we say that, like in venture, there's a wide range of what the returns are going to be. This is not an index that you can just go buy an index fund and you're going to have a variation of 0.01. The manager's performance is dramatically different from the top and bottom managers, and only about the top 10% of managers produce the kind of returns that these graphs show the venture capital industry produces. So spend time finding the right managers, view them like you would any other long-term employee, because this will be a 10 to 15-year relationship.
Great. I think that's really helpful for some of the folks who are newer to the asset class. Let me ask you the same question, Victoria, and then after this, I am going to turn to audience questions. But do you have anything you would add in terms of advice you'd give to smaller family offices who may not have the breadth of experience that you've had wearing different hats in venture?
Yeah, so, I think venture is one industry where people are extraordinarily open to meeting with individuals, right? And it's one that is a very relationship-based ecosystem. So I think in the beginning, my advice would be to dip your toe in, right? Get to know a couple of different venture managers, get to know a couple of different corporate venture funds. I'm super excited to engage with family offices for our fund too. I just, as I mentioned, feel free to reach out to myself, right, as a resource. I think in this industry, it's a funny thing. Talent is everything, right? Because it does require, I think, to Michael's point, right, some amount of skill, and it's revealed in the distribution of the returns, right? The returns tend to, within venture capital, fall to a small group of different types of funds, and for whatever reason, everyone thinks they can do venture, right? This is apparent, I think, in a lot of like corporate VCs. So many corporate VCs, and even at Citi, go through this process of they have someone internal, maybe someone in business development, someone in corporate development, someone in finance, or even technology, who gets interested in venture. They decide, hey, let's just set up a venture fund, and then they go out and they start like investing in companies that they see, right? And then it doesn't work out, and they realize they have to go back, re-strategize, figure out what went wrong and how they can really build a better venture capital arm, and then they go out and they find professional venture investors, right? So I think in the same way that you wouldn't have a sort of an inexperienced person start trading commodities for you at your family office or at your corporate venture fund, I think you want to also have an expert, right, run the venture capital practice or allocation. Venture, the way that I always say is it has low barriers to entry, but high barriers to success. And so anybody can come in and write checks, but not everybody makes money. And so, I think talent is very important there. The other thing that I would say is that, in working with different VCs or different corporates that you want to collaborate with, no two corporates are the same, right, from my experience. No two VCs are actually the same, although they tend to have more similarities than corporates. And for every corporate, there is a very large spectrum in terms of what they care about, right? Are we building this specifically for financial returns? Are we building this specifically for strategic returns? Do we want an amalgamation of something in between? Or, is it really an R&D budget, right? Instead of us spending the capital to try to test out new technologies, we're going to invest in companies and have them test out new technologies. So really think about what are the types of corporates you want to engage with for the purposes of what you're trying to accomplish for your own program, right? These are very long-term, highly liquid, somehow they're getting even longer term, highly liquid securities, right? And they're very deeply relationship-based. So it takes a while to sort of get to know that ecosystem. So I always recommend, getting to know a couple of venture funds, maybe being LPs in a couple of venture funds. And once you're in that industry, you can start to develop your own thesis on how you want to approach it in a much more direct fashion if you wish to.
It really resonates with me that this is a game that's easy to learn and hard to master. Like checkers, perhaps, more like chess. I think that's true, and I do think that one small silver lining in what's been a tough year for COVID is that the overpopulation of venture funds may be thinned out a little bit by having a challenging underlying year for some investments. So we'll see if that happens. All right. Well, I want to turn to questions from our audience. We have a few coming in and encourage people to keep sending them. I think you've addressed this, but just to clarify, our first question from Robert Goldbaum is clarify the name of your new firm and maybe spell it for folks.
Oh, yeah. So it's Proven Capital, P-R-U-V-E-N Capital. And you can
Capital. And I think of that as an abbreviation of Prudential Venture, Pru-Ven Capital.
We made a little play on words there.
Yeah, I like it. Works for me. No, that's great. And I think you're getting the word out to a lot of high quality family offices right here. I have a question from Kyle Theodore, who asks, for folks that are active with underlying venture businesses, what's the most productive way for people to engage with each of you regarding those firms without being taxing and hopefully only being helpful to your respective firms? What I think Kyle means is that he's a vendor to family offices and venture firms and is wondering how to engage with each of us without while being only helpful. Let me ask Mike first and Victoria if you have any thoughts on that.
I would say I'm fortunate enough that we have a pretty robust structure around our firm. So we have an accounting department. We have, just like a normal corporation, we have departments that handle various parts and work with different service providers. So I generally tap their expertise. So if I need, a new methodology for valuing an investment, my CFO is going to go out to their service providers. And likewise, if I have a question on a new, terms of an investment, we're going to go over to our general counsel, and they're going to have a set of service providers that they're already working with.
Victoria, anything that you would offer to service providers seeking to engage with Proven?
Yeah, I mean, look, like I am always looking for high leverage, right? So whether that is in an individual, right, and I can get 10x out of the individual than like somebody else, or whether that is in a technology platform or capability, I love hacks. Like life hacks, like anything that helps me spend my time where I want to spend it, right? Which is really with my portfolio companies, or outsourcing new deals, or out like helping to provide more value to my LPs, right? Like that's like ultimately where I want to spend my time. So the way that I think about it is, if you can create more time for me, then that is really exciting for me, right? Because at the end of the day, the only thing that is not scalable is us as individuals. And so we're always looking at what can give us more leverage, right? Right now, I mean, I think I've like tried like 10 different like CRMs at this point, right? Like we're always looking for ways that we can improve our program and our platform so that we can outperform.
Yeah, and all I would add to that is that, as a GP running a fund, I'm trying to spend as much of my time, like Victoria, with LPs and entrepreneurs, and as little of my time with everybody else. Often when I'm approached by a service provider, I'm not always responsive. I don't need them until I need them, and then I need them in a hurry. So sometimes you get a little bit of hurry up and wait from me. But again, it's at the end of the day, it's all about leveraging time and being open to folks who can allow me to spend more time with LPs and with entrepreneurs, and those are the folks that I respond to. Let me move on. We have I think a good question from Michael Duda as a GP. Michael says that he's raising his next generation fund, which will transition from high net worth to family offices. And as a GP, he's asking what steps should he be taking to get smarter about this group, and I think he means corporates, related to understanding decision-making, key terminology, etc. Let me take an initial crack at this question, and then invite our panelists to chime in. I find that, and I think Victoria may have made this point earlier, that the corporates tend to be, they're easy to talk to. I mean, we're an independent VC firm at Impact that our core identity is that we're the good partner to corporates. Because we've sat on that side of the table, and we think that one of the dirty secrets in Silicon Valley is that sometimes the relationship between corporates and independent VCs hasn't always been harmonious because they have different objectives. Sometimes the corporates have finance objectives, sometimes they have strategic objectives, but whatever their objectives, most of the corporates I know are eager to engage with the broader venture ecosystem and tell them what their objectives are. Just in the last quarter, I've been working with Aaron Anderson on the Impact team to reach out. We have had calls with at least 80 corporate venture arms in the last quarter. They're happy to tell us what their thesis is, what their goals are, and they ask us what companies in our venture portfolio already or that we're considering putting into our venture portfolio might intersect with their own thesis. So in a typical conversation, we'll go in, we'll learn about their thesis. We have 21 portfolio companies. We'll identify which 2 or 3 we might want to tell a corporate about, and they're pretty easy to reach. In some cases, we find out that their thesis doesn't intersect with ours, and we just agree to check in less frequently. In other cases, it intersects, and we engage at least quarterly. And when we invite corporates to have frequent updates with us and review the portfolio, we generally get a positive response. So one way that I'd say is one way to get access to corporates is you can do it through us. I mean, one of our marketing points to our LP investor base is that we have those relationships and you can reach corporates through us. But I would also say that you can reach out to many of them directly and find them to be relatively open to building relationships with new GPs. Victoria, let me ask if you'd add anything to that.
Yeah, I mean, I think it sounds like it's more of a fundraising question. So maybe Michael has some more thoughts on that, but we went about it a little bit differently, right, for ourselves. We went straight into what's a large corporate that we would want to be able to partner with, that we could leverage in a much closer relationship, right? I think when it comes to working with corporates, there's different levels of corporates, right? There are corporates that are right now thinking, oh my gosh, I need innovation, and I don't know if I have, that specific skill set inside of my company, and I want to go outside, right? And so they're going to start thinking about really two things. Do I hire someone to bring into my firm, or do I go out, do I make some LP investments and, learn from them that way, right? So I think when there are corporates that don't yet have VC firms, or sorry, VC arms, I should say, but are clearly interested, or their industry is being disrupted, right, by technology or by new business models, they're going to be looking for that next solution strategically. And that's probably a good place to start to engage. Sort of the next level over is like there's VC arms inside of corporates where they've maybe brought in a couple of people, they're managing a portfolio. If that portfolio either hasn't quite performed as well as they thought, or they don't have the resources to really dedicate to building out a robust venture program, then they may also start to consider, okay, do we want to actually outsource this capability and bring in innovation in a slightly different way, right? So there's sort of different levels of like where corporations are in their journey, and also in terms of like what their strategic end goals are, right? Where I think a lot of VC GP managers can come in and be helpful. But on the family office side, I think I'm sort of at the beginning of that process, and I'll let Michael talk much more to that.
Well, actually, I think you've given a good GP perspective, and we're not going to get to all the questions. So with Michael's forbearance, I'm gonna move on. I do want to come back to Kyle Theodore, who I has reached out to clarify his question, and I may have misrepresented him as a service provider to funds. What Kyle clarifies is that he's representing the actual startups and looking to share those startup investment opportunities with each of us as potential investors in those startups, and how can he best engage to do that. And what I would offer to Kyle is that we at Impact Venture Capital are always looking for entrepreneurs to invest in. We receive 40 to 50 pitches a week, so I would just ask people to understand that we will get to it, but we give it to a screening committee on our team to go through and try to identify which opportunities intersect with our own thesis, early stage AI application, that thesis, and then go through a checklist to identify whether a GP should get on a call with you and with that startup. I would also offer that for us, and I think this may be similar for other GPs, we always look first at the opportunities brought to us by our existing LPs and partners. So we will eventually look at anything that's provided to us by someone we know and trust, but when we're deciding each week which ones to look at first, we look at the ones that come from the folks that have already partnered with us. So I hope that clarifies. I apologize, Kyle, if I misrepresented your question earlier, but I just wanted to say that, yeah, we welcome incoming deal flow from all sources, and you can always send those to me, Eric at impactvc.com. And let me ask Michael and Victoria if you look for how you respond to incoming opportunities for investment in new startups.
Yeah, and I'll even broaden it to both VCs and startups. I think number one is understanding the investment thesis somebody's going after. So I get approximately 300 to 500 emails a day. So the only ones I'm going to respond to are the ones that are pertinent or from my management team. So we can get pretty delayed on emails, but really understanding the strategy. So for instance, I get a ton of biotech transactions. We don't do any direct biotech investments. We'll send a few interesting ones over to some of the managers that we work with. But when people understand that we don't do the biotech investments direct right off the bat, they're never going to get a positive answer. I think that's true with any venture firm, understanding what they're looking for. And even on the venture firms, we get a lot of inbound, hi, I'm starting a new fund. I think if you're looking to start a fund, making sure your information's up on pitch deck, because I think a lot of when you go from high net worth to especially family office or any institutional environment, there's going to be a lot of pulling of past information. There's going to be a lot of, is this fitting the strategy of what I'm looking for? And then, clearly articulating what your investment focus and thesis is so we can make sure it fits an allocation. And if it's a no today, it doesn't mean there'll be a no tomorrow, because our allocation is dynamic and actively shifts. So understand it's not personal. It's just it doesn't fit the box we're looking for today.
Okay,
Yeah.
and Victoria, how do you distinguish between reacting to incoming deal flow, a gatherer, as Michael would put it, as opposed to being a hunter and identifying that deal flow yourself?
Yeah. I'm trying to think back. I think I have, in your words, hunted for all the deals that I have done. But I've always looked at like the deals that come in, right? Because you just never know, right? Like that's the funny thing about our industry, is you just never know where that next deal is going to come from. So we meet about 1,000 companies in a year. It's a lot of companies, right? We invest in, I don't know, call it maybe like 10, 20 companies, right? So it's this very small percentage. The way that I think you ensure that you get seen is that you check all the boxes, right? So for us, it would be, are you raising a Series A to a Series D round, right? Are you looking for an investment in one of the verticals that we invest in, right? Do you, and then I think the other piece of it is, are you getting across very clearly and crisply what your company does, what market you're in, like what this team is, right? And why they can be the right solution? Because if it is not, if it's call it like a completely cold email, I may be spending only 5 seconds on it, right? And so if you can't get it across in that time, then unfortunately, again, time is the limiting factor, right? So that's what I would focus on. I think I've gotten a couple of like messages where somebody attaches like this 20-page like business like overview, and just like I just can't, right? Like I can't consume that. So make sure that whatever you are getting across to people is highly consumable in a very, very brief amount of time. And if it is compelling, they will absolutely reply back to you. I have definitely met with a number of companies that came completely cold that were super interesting, just too early stage.
As have we, but when I get an email saying, here's a 20-page overview, are you available later today to discuss? The answer is always no. I am not available later today to discuss, but I'll get it to the junior team. Some fraction of those, they'll come back and say, yeah, let's learn more about that. And 4 weeks later, I may be available to discuss for some fraction of what I receive. So I think it's similar to Victoria.
I'm actually in the process of I'm thinking about building a little something that helps to structure some of those inbounds, but TBD on that project. Hopefully,
Sure.
hopefully we get it up and running in the next couple of weeks. But I have some interesting ideas on how we're going to consume that.
Well, that's great. I look forward to seeing how that develops. We're almost out of time. I'm going to abbreviate and combine. I've received multiple questions about India. Do we invest in India, and how do we see emerging countries like India for fintech in particular? I will just offer that at Impact Venture Capital, we have a global mandate, but we don't have a global presence. So we tend to invest in locales where our LPs come from. We will invest in India when we have LP investors from India, probably not beforehand. And we have not so far invested in India, though we don't have an aversion to doing so, but we need to have somebody we're associated with a local presence before we get too engaged with a particular country. That's what I'd say about India, and I'd just leave it for the last answer to Victoria in terms of how do you perceive India, particularly in fintech and lending tech, as a location?
Yeah, I mean, I think there are tremendous opportunities in emerging markets to leapfrog all of the past experiences that the U.S. and other developed countries have had, right, when it comes to fintech. So very bullish on the emerging markets. The approach that we have right now is we're all based here in the U.S. And I think for me, I've always been a believer in you should be investing in things you have expertise in, whether that is technology or whether that is regional or whether that is industry, right? And so I think until we have some expert VCs in various developing countries, we will probably be very selective about what we invest in those countries.
That's great. I appreciate that. And with that, I think we're out of time. I would like to ask our audience to please join me in thanking our panelists, Michael and Victoria. I learned a lot from them today, and I hope that it was useful for you. I know we didn't get to all the questions, but I promise our attendees I'm going to look at the questions that were submitted, and I may reach out to people so that I at least give my perspective on any of the ones that we didn't have time to get to. With that, I want to thank Lindsay and the Family Office Network for this opportunity to share an hour with everyone here.
Eric, Victoria, Michael, thank you so much for joining us today. As Eric mentioned, we will be following up with all of you. So if there are any other questions, we'd be more than happy to get you in contact with any of the panelists today. Again, we hope you have a fabulous day, and we look forward to speaking with you soon. Bye for now.